Hi, I'm Tyler Wanzak with Max Masters, here with my friend and lender in the business, Zach Smith with Chariot Financial. Wanted to talk about some of the news articles that's come out and just some of the changes that's happened in the loan industry. One thing that's definitely the hot topic is how the U.S. is trying to subsidize high-risk home buyers and basically adding a little additional fees to somebody who has kind of that perfect credit, a bigger down payment. Generally, how the bank sees that as an investment is, hey, these people are going to pay it back. They have a good credit history.
Yes.
And now that's kind of changing. I wanted to kind of just dive into that with you. I know you've spent a lot of time. We've kind of chatted a little bit about this. Give me just kind of your first spin on this, on your thoughts.
Sure. Yeah. So this is it's been going on for a long time. This isn't anything new. But now some of the changes to Fannie and Freddie are making it a little bit harder, or it's costing a little bit more for people who have good credit, which seems completely opposite, right? Are we in bizarro world right now? If you have good credit and you have money down, you should be paying less. You should be rewarded for that. And it doesn't seem like the new policies are exactly presenting it that way.
And I would say this is something that has been happening, kind of the scenes for a while, but to also say that it's jumped from 0.25 to a whole 1 point basis, I don't think we've ever seen that kind of jump. And that's why I think the headlines, it comes at a time where interest rates are a little bit higher. Why are we trying to make it just a little bit more difficult to buy in this market, and
there is that, but the idea of the policies, that the proponents of these policies are saying that let's make policies to get more people in the marketplace. So we want to try to, or what they're trying to accomplish is they want more buyers. They want more people to be homeowners. We have a lot of social, issues that occur all across the nation, many of them stemming from education or crime, things like that. It's been found that homeownership improves both of those things. So I think that the idea is to bring a bigger pool of buyers into the marketplace. Is it exactly fair?
Right.
Probably not.
Well, I mean, to say that yes, you're going to give more opportunity to people with a lower FICO score, credit score, bringing less down. But I think the majority of our buyers are still the responsible, hey, I've been, making my payments, I have this lump sum. So you're really, I think if you looked at just the majority of loans that are still going out, it's really just the banks that are winning on this. They're being able to, collect just a little bit more. And, who takes it on the chin? The people that have been paying their bills,
doing the right thing.
You've always, I was raised to, pay off credit cards on time. I was raised to, not overspend, not overindulge. And it just seems a little strange that we're kind of incentivizing. I'm not saying to run out there and stop making all your payments. You're going to get a better. It's not dollars for dollars. It's not going to make sense for you. Don't go ruin your credit. But at the same time, it's a head scratcher. And
it is. And it's one of those things where I think the intentions are good, and who knows, it may bring more people into the housing market. But I do think that the big winners in this are probably going to be banks.
I do. I love the incentivize. I think me being a homeowner, it just does something to you. It is, and I want that feeling for majority America. So I do understand the incentive, the push. I just wish it was more of maybe like, hey, we're lump summing this amount of funds towards it, instead of saying, hey, you that you've been saving, you might have been. You drove the same car for 10 years, and you've been making all your payments, and you've been living within your means. Now you're ready to buy a home. Oh, hey, we're going to hit you with a little bit extra. So, like I said, the world is taking crazy pills, and we're just trying to dissect it for you guys. Ultimately, we have programs that's still going to work. The rates have kind of been jumping up and down, but at the same time, talk to us. We have great little strategies for every different scenario. Not one home's the same. Your financial situation's not the same. wanted to kind of break this down. Do you want to kind of go into a little bit more, maybe what that additional fee would be on any, like a $400,000 loan?
Yeah.
We kind of talked about that.
Yeah, so there's a chart that we can share.
We'll put that up.
We can share that in the video here. And keep in mind, when we say it's a 1 point adjustment or a quarter point adjustment, that doesn't exactly equate to the interest rate itself. We're talking about loan level pricing. So what is loan level pricing? Well, as mortgage people, when we price out a loan, basically we put it into the system and we put all the things that are going into the loan. How much are you putting down? What's your credit score? Things of that nature. Is it a primary residence? Is it an investment property? So when we put all that information into pricing out a loan, we get what's called loan level pricing adjustments. So for instance, if you're purchasing a primary residence, your rate is going to be different than it would be on an investment property, mainly because of the risk factor. They see that investment properties are a little higher risk than your normal, plain vanilla primary residence.
Right.
So these price adjustments are going to be made on the back end. So it's not like a point for point adjustment, but it is going to adjust the rates a bit higher for some people who are putting 20% down and have really good credit, as opposed to people who are putting 3% down and don't have very good credit. So the adjustments, you would think that you'd be rewarded for good credit, doing the right things and all that, but it's not the case with these type of policies. And again, it's one of those things where if you're looking to debate this policy as if it was fair or not, there's really no debate.
Yeah.
It's not fair.
Right.
But to open up the doorway for more people to buy homes, I think that's really the intention of the new policies.
I hope it works. I love your positive spin on this. I think most people that I've talked to are just not as cheerful as you are. So I appreciate kind of the back and forth here. I wanted to kind of open that up. But I mean, at the end of the day, we still have buyers buying. I mean, we're still making it work. It's everyone's looking for just the end of the world and like, hey, things are good out there. Like it really has been. I mean, the sellers are kind of back in the driving seat, a little bit, but inventory is kind of starting to pop here. It really was. It was just kind of that first warm day of spring where everything just kind of flipped.
Yes.
So, if you have any questions for us, we're here in the tech center. We're all over the greater Denver area, but we'd love to just kind of sit you down and set a plan for you to become a homeowner. In any shape or fashion. So anything else you want to kind of say before we sign off?
So here's a little chart that we have put together that shows some of the different loan level price adjustments. And as you can plainly see, if you have a score of 640, you'll be paying significantly more than if you had a score of 740. Using 80% loan to value ratio as an example, your LLPA or loan level price adjustments at 640 is 2.25% versus 0.875% for a 740 score. That's a difference of 1.375% or just over $4,000 on a $300,000 mortgage. This is almost half of the previous difference, and that's certainly a big change.
Yeah, I really appreciate you coming in. It was great, and continue to work with you. And it's going to continue to be a busy year.
That's right.
So,
That's right.
All right, take care.